So today I want to talk about the average investor. The average investor, it turns out, is way below average, which doesn't make a lot of sense, but let's take a look at that. Here's a chart that is from JP Morgan Asset Management. There are other providers that will give you very similar information, but the idea here is that we're going to look back 20 years and we're going to see how different asset classes returned. We see that REITs did very well, but we go way over here on the right, we see that the average investor did really poorly. There's a technical term for this, and that is you suck, Mr. Average Investor. Now, in all fairness, the average equity investor did better. They returned 4.25% during this period of time. But if we compare that to the S&P 500, which is an equity index, we can see that they did significantly worse than that. Now, we can also go to different time periods. Here's ending 2018, same kind of information. Average investor does poorly. Through 2017, hey, at least they beat inflation this time. Here's, through 2012, again, the average investor doesn't do very well. In fact, they often don't even beat inflation. Now, of course, the big question is why. I'm going to argue that a lot of it is cognitive errors and behavioral biases. I have a ton of videos on this. Here are links to them along with the topics that I cover in each video. The general thing here is that the parts of our brain that help protect us as hunter-gatherers in sub-Saharan Africa served us very well there, but they actually have the opposite effect when it comes to investing. They make us worse investors, as we can see by the evidence there. Now, in general, we kind of do this thing where we buy high, we sell low. Our market timing is terrible. We overreact, especially during times of uncertainty, times of crisis. I have a video you should check out, which is right here. In that, I argue that, hey, things are always uncertain. In fact, when we think things are certain, they're probably more uncertain because those things that we don't know about are actually looming in the horizon in the future. And when you need to come up with a plan for how you're going to deal with the next time of crisis. We also do a tremendous amount of herd behavior, which hurts us tremendously. I have a ton of videos on that. Think Tesla, think Bitcoin. I also have a really nice video in there where I sit down with Roger Ibbotson for about an hour, 45 minutes to an hour. And we talk about popularity, which is a way that he kind of formally talks about herd behavior and incorporating that into an asset pricing model. Pretty interesting video you should check out. So in terms of the average investor, it's a lot of just bad timing. So if you think about asset allocation, what asset classes are you in? Stocks, bonds, equities, treasuries, whatever that might be. In general, we're not doing the right thing. I have a video you can check out here where I say, your risk tolerance is really time horizon dependent. So think about that video and think about how you're allocated. A lot of times we're just not invested, right? We have 20% of our wealth invested. And so that's definitely going to hurt us. A lot of times, hey, the hot stock, the hot mutual fund, whatever, we buy that right before it does terrible. And we sell the one that's been doing poorly, the crappy one, but it turns out it's about ready to go on an above average tear. A lot of times, when it's a bear market, we're in it only, and then when it's a bull market, we're out of it because we're just, again, timing things very, very poorly. Lots of evidence to suggest all of these things are true. So again, happy trading out there. Wait, well, maybe not. In fact, a bonus video for you here where I talk about maybe why you don't want to trade, how you could be better off by basically doing nothing. So trading or not trading, good luck out there. Grow your wealth. Thank you so much. I'm Brian Kozlowski.